So imagine this. You're out shopping for the home of your dreams. You know you have great credit. You got a great job with steady income and steady employment. You have enough money for the down payment. And again, you find this home of your dreams. So you go and talk to a lender to get a mortgage and they say, look, your credit's over 750. Your credit's awesome. You've got enough money for down payment, but we have a problem with your DTI and we can't get you a loan right now. Your dreams just got crushed, all because of DTI, which is also known as... Hi, this is Joe Harris from Keeping Your Business on Track. I'm here with Nick Morgan. How you doing, Nick?
I'm doing great, Joe. How are you?
I'm pretty awesome. Nice long weekend.
Beautiful.
So, hey, so what are we talking about today?
Yeah, so today we're going to be talking about DTI.
Ooh,
And I was wondering
nice.
if you could maybe expand on that. What is DTI?
What is DTI? You mean, what does it mean?
Yes, sir.
Your DTI is the acronym for debt to income. And really, this is an important piece because it goes to the affordability of a mortgage for a home buyer, right? It's how much income do you have versus your debt. So we calculate this. Am I going too fast or should I slow down?
No, that would have been my next question is, how do you calculate that ratio that you're talking about?
So the debt to income ratio, basically, you look at all your debts and divide it by all your income, what's allowable and normal on the loan. So the debt piece is anything that would show up, any monthly debt obligations that show up on a credit report, and some that might not, like if you do have, let's say, if you have to pay alimony or child support, typically not going to show up on a credit report.
Yeah.
But those are going to be considered liabilities and built into your debt to income.
For sure.
And other things like if you have car payments, student loans, credit card minimum payments, things that show up on your credit report, some that don't, like I said, if there's alimony, child support, or if there is other payments that you've agreed to pay that will fundamentally impact your affordability on the loan, right? Now, there's some things that you don't count, and there's a whole string of those, and we don't need to get super specific on that.
For sure.
And as far as your income, it's all of the allowable income that you have that we're going to count. So anything that your job, your W-2 employment, whatever the lender deems as allowable, for the income, as long as you have a history of it, typically a 1 to 2 year history, and it's going to go on for the foreseeable next 3 years. And a lot of people say, Joe, but no one really knows if their job's going to be around for the next 3 years.
Right.
But if there's documentation to suggest that it's absolutely not, like if you're on a 1 year contract and you don't have a history of doing a 1 year contract, and it doesn't talk about, if it's not normal and typical for your employment, then we might not be able to count that. But if you're talking about a W-2 or even a self-employed borrower, we're going to look back 2 years and we're going to look at what we can count for the income. And so we're going to look at all your monthly debt obligations that we have to count, as well as the new payment on that property. And we're going to take that and divide it by your gross monthly income that's allowable.
Gotcha. Awesome.
Does that make sense?
Yeah, absolutely. I appreciate all the detail. And since it is a ratio that we're talking about, numerator, denominator, what is the perfect number, or what is the acceptable number for that ratio? And does loan types such as VA or conventional FHA, does that affect what that number is?
Yes. Great question. There's acceptable is a wide range, okay? Because a lot of these loans, yes, there is a maximum on say a conventional loan, conforming loan, a Fannie Mae, Freddie Mac. 45% is, you can go up to 45%. You can exceed 45% and up to 50% with compensating factors and what we call an AUS, or an automated underwriting system, a computer basically that runs all the information and says you're good.
Yeah.
Up to 50%. Over 50%, not really doable, okay? On a conforming conventional loan.
Gotcha.
So your Fannie Mae, Freddie Mac, standard bread and butter, cookie cutter type loans. Now, VA doesn't technically have a top end or a maximum debt to income. VA is used as a more holistic approach. They're going to take a look at your loan. They're going to take a look at all they look at your income and then your debts and then what's left over afterwards.
Yeah.
And as long as you meet the minimum residual income, what's left over afterwards, after you paid all your bills, you can typically go higher. If you exceed your residual income by 120%, you can typically exceed that 45 or 50%, but it's going to take into look the compensating factors, the credit score,
Yeah.
time on job, and all the other factors.
Yeah.
And so it doesn't necessarily have a maximum debt to income. But then again, a lot of lenders will put caps on that,
Yeah.
on what's allowable. Not all, but a lot of lenders out there. FHA, typically it's 55% is your maximum, typically. Some have lower, and other types of loans have various different debt to incomes, but it has to make sense for the borrower.
Okay, awesome. Just out of curiosity, since you did say VA doesn't have a cap, what's the highest DTI that you've ever seen that qualified and was
Right.
like a good loan?
I really really hesitate in putting that out there,
Yeah.
because everyone's situation is a little bit different. But I remember doing one at 67% debt to income, and you're like, well, Joe, that's gross monthly income you're talking about, but you have to have a lot of residual income for that to make sense. And maybe there's a good reason why they're going that high.
Yeah.
But typically, in the 50s is as high as you want to go. Because you also remember, just because you can do it doesn't mean you should.
I agree. Yeah.
Because for the wrong borrower, you're tying them to a loan. You're setting them up for failure. Now, I don't like to make decisions for people, but our job as a lender is to make sure that we do the right thing for the borrower.
Yeah.
And putting someone into a house that's going to drag them down
Yeah.
might not be the best thing. But if they have the compensating factors, right, then there might be a lot of money in the bank. There might be a lot of residual income. If you make $3,000 a month, half of that is $1,500, right?
Yeah.
Well, that $1,500, let's say they went up to 50% debt to income, that means they only have $1,500 to pay all their bills. Not to mention that debt to income is calculated with gross monthly income typically. So they're going to look at VA is a little bit smarter. They actually take a look at the residual. They take out the FICA and the Social Security and anything else that comes out of there. But on a conventional loan, they're looking at your gross monthly income. So if you make, let's just use easy numbers, $10,000 a month, great living, right?
Yeah.
Well, you have to pay Uncle Sam too, right?
Yeah.
So let's say you're in that 20-30% tax bracket, then you really don't get $10,000 a month. You might get $7,000 or $8,000 a month.
Yep.
And that's already at a 80% of your income. So if you think about going up to 67% debt to income, your payment is almost, your debt is almost covers all of your
Everything. Yeah.
that you get out, right?
Yeah, totally makes sense. It just piqued my curiosity. I was curious about it. So moving on, does your DTI affect your interest rate? Like, let's say if you have a higher one, is that going to affect the interest rate that you're going to get on your loan?
It actually does now on conforming conventional loans. There's actually what Fannie Mae and Freddie Mac called loan level pricing adjustments. So if you have over a certain amount of debt to income, you're going to have a rate hit because it's risk-based pricing. So if your debt to income is over a certain threshold or below a certain threshold, your rate could be a little bit higher if you have a little bit higher of a debt to income.
Okay, awesome. You kind of touched on it a little bit, but are there any exceptions to that maximum rule that you were talking about earlier? I guess you hit on it with the compensating factors, but is that the only way you can kind of get by that maximum acceptable number?
Well, let's talk about a conforming loan. So really, they're going to tell you it's 45%, and you can exceed 45% up to 50 with said factors. Now, loan officers these days are just going to take your information and run it through the system, right? And the system's going to say you're good. Yeah. But remember, if you're getting a pre-approval at 50% debt to income, if the wind blows the wrong way, you're going to blow yourself out of approval. If you get a 51%, that's going to be really tough. Now, assuming that there's no other way to fix the debt to income, which I'm sure we can get into, that there's no other way, and then the taxes and insurance were higher than expected, the mortgage payment, the debt, the principal and interest payment on that loan, that's pretty easy to predict. If you give me the loan amount, I'll tell you what the principal and interest is. But now in Florida, the taxes and insurance, depending on where you are, might be very expensive and have a huge range. So to predict that, it's going to be very tough.
Gotcha. And since you touched on it a little bit, if you do have a higher DTI, what are some things that you can do to improve it?
Well, you look at it from this perspective, is that if you have a ratio, right, there's a denominator, a numerator and denominator.
Yes, sir.
It's been a while since I've had math class. But a numerator and denominator, you can fix either one of those, right? So if I say, well, the bottom one's the denominator, that's the income. So I can either make more money, well, that's going to be tough to do because I have to have a history of doing that. So then it goes to the expense column, right? Are there expenses? Let's say you were planning on putting 20% down. Okay,
sure,
that's a great goal. Then you don't have mortgage insurance on a conventional loan, and you have other debts, right? Yeah. We can take a look at the whole picture and say, well, look, if you pay these debts off, instead of putting 20% down, because of these payments, your cash flow might actually improve, even though you're going to have mortgage insurance on that loan. And holistically, it looks like a better deal, and I can get you to qualify if we pay this debt off over here.
Gotcha.
Sometimes we can help people restructure their debt. Sometimes we can look at this loan and say, you know what, have you thought about doing this different, buying this type of house, a little bit less of a house, right? Putting a little bit less down, paying these things off, and we can still get you into property.
Awesome.
So there's lots of things we can do. Now, a lot of places you call and you say, this is how much money I make. Okay. These are my debts. Okay. And they're going to say, you don't qualify. Thank you very much. We'll see you next time. Right?
Yeah.
And that's a really poor way to do business. But we find that a lot of our competition does that. They don't get into restructuring debt, looking at what's the best and highest use of that down payment money. Maybe saying, well, look, don't pay this off. Pay this one off or something of the sort. There might be a solution in there. If they have income, if they have decent income, they have decent credit, and they have some assets, there's a lot of things we can do to see what we can make sense out of.
For sure.
That's what a professional mortgage loan originator should do.
Yeah, there's a ton of clever ways to not get around it, but just solve the issue that if you're looking at it straightforward, you might not see it at first.
And this is where a lot of the technology companies do fail in this, is because their systems, they don't know how to do these restructurings or how to at least explain it to a customer, in a way that makes sense to them.
Right.
And a lot of the bigger companies, these might be hourly employees. Maybe they're not commissioned. Maybe they're not. Their pay isn't structured to help you succeed and win. And winning means getting the house of your dreams.
Totally. Awesome. So last question I have is, now let's say you do qualify in a pre-approval with a set DTI. How often is that DTI then reevaluated throughout the loan process? And if it goes up, is there a possibility that you may then be unqualified?
Well, I'll just answer that very last one. Yes, if your DTI exceeds what's normal and allowable on the loan, then you're not going to qualify,
right?
Unless we can fix it. So you said when you said the loan process, do you mean from when they get pre-approved, or do you mean actually when they get a contract between then and closing?
From when they get a contract to closing.
Let me address the other one first, the pre-approval to contract, okay?
Yeah.
So if you get pre-approved and something fundamentally changes, like you get a new debt that wasn't expected, or you get a demotion at work, or you get a different job that doesn't have the same pay, or you incur more liabilities or debts, yes, that pre-approval is only as good as the consistency of the information. And if that information changes, well, so will that pre-approval, right? So yes, that could knock you out from getting approved for the loan, because the pre-approval says as long as you don't fundamentally change your income, your assets, your credit, you are good to go. Right? As long as you buy a house within these ranges with these parameters.
Right.
Now, once you get into the loan process, we love to read the 10 Commandments on mortgage lending to people, because there's a lot of things that can change between now and then. I've seen people change jobs. Okay, that's a problem. That could be a problem. Could be a problem. I've seen people buy new cars. And I tell people, if you're going to buy a new car, you might be living in it, right? But the one instance, I had a good friend that I did a loan for a while back, and he's like, I ordered this car about 8 months. This is during COVID times when it took a long time to get a car. He's like, dude, I'm so sorry. I ordered this car about 8 months ago. I never thought it'd come in by now. I thought it'd be another 6 months, and I got to buy it. I was like, all right, well, let's take a look at things. Well, it was with this particular gentleman. It was an expensive automobile, but he had a good income, and he didn't have a payment before, and he still was within the guidelines. But had he been right there up against the guidelines, he wouldn't have been approved for that loan.
Right.
So yes, we're going to evaluate it, and we even pull credit per the guidelines within 10 days of closing. Now, it's a soft pull, but we're going to know if new credit was obtained. We're going to know if your balances went up on your credit cards, and a lot of other things that might affect your debt to income ratios.
Awesome.
The debt to income is important because it shows your ability to make the payment. If a lot of people might say, look, Joe, I know I can afford this payment. Even though my rent's a little lower, I know that I can afford this payment. But I'm looking at the loan going, man, you're at 50, 60% of your debt to income. The rules and guidelines say you can't.
Yeah.
But, well, because I have my buddy sublets a room and I know I have the money. Well, I can't prove that,
Yeah.
That's going to be troublesome to prove.
Yeah.
But the importance of the debt to income is that there's been a lot of loans done, right? And they take that information and say, this is the most likely to succeed and this is most likely to fail based on the info. And they apply these rules throughout. They have to, they have to have some kind of standard. There's always going to be anomalies and parts of the population that don't necessarily fit the rule, and they might be a good candidate to exceed that, but the rules don't allow it because a lot of the QM rules that were the qualified mortgage rules that were put in place back in 2010 to prevent another meltdown of our mortgage market, we had to apply rules evenly across the basis. Okay, so the debt to income was meant to protect the borrower from getting into a loan that's over their head, and that statistically they're going to be unable to perform on that loan. But it's also meant to protect the lender from that same thing, because then they might have a potential buyback or foreclosure situation.
Bad for everybody.
Bad for everybody. Yeah.
Sweet.
So does that make sense?
It does.
Okay,
Yeah, absolutely.
Good. Well, look, this discussion of debt to income's one of the biggest factors in getting qualified for a mortgage is affordability. Can you afford the payment? And the debt to income, the DTI, is supposed to show the lender and the rules that you can afford that payment. So if you have any questions on this or anything mortgage related, please reach out. There's some contact information below. If you're not a subscriber, please subscribe, like, share, do all those things, and we'll see you next time.